Let me walk you through something I saw last week that genuinely surprised me. Two people, same neighborhood, same income on paper. One is still getting up at 6 a.m. to catch a train, packing lunch, sitting through back-to-back meetings. The other spends the morning watering roses and reading the paper. Last year, they each had about $100,000 come in. But what went out to the IRS was not even close to the same. The person still working paid over $15,000 in federal tax. The retired person paid less than $300. Same country, same tax code. One of them paid more than 50 times what the other paid. I remember the first time I saw a comparison like that. I was looking at my uncle's tax return, and I honestly thought his accountant had made a mistake. That kind of difference did not make sense to me, so I checked it twice. It was not a mistake. That is simply how the tax code treats working income versus retirement income. And if you are in your 40s or 50s and you do not understand this yet, you could easily spend the next 10 or 15 years saving for a retirement number that is way higher than it needs to be. Not because you are bad at math, but because you are using the wrong tax assumptions. Let me introduce you to a person I will call Mark. Mark is 45. He works as an engineer. Every 2 weeks, he opens his pay stub, and right there, just above his net pay, is a line called FICA, $612, gone. Before he even touches the money, Mark has always assumed that line would follow him into retirement. He thought it was just part of being an American worker. It is not. The moment you stop receiving a W-2, FICA disappears completely. That is the Social Security tax and the Medicare tax, combined at 7.65% of every dollar you earn from a job. On a $100,000 income, that is $7,650 that simply stops being taken the day you retire. That is the first reason Bob, the retired neighbor, pays so little. But that is just the start. The second reason is the standard deduction, but with a twist. Most people know about the standard deduction. What fewer people know is that the IRS gives you a larger one once you turn 65. For a married couple filing jointly, the total standard deduction can climb past $46,000. That means over $46,000 of income is completely shielded before the IRS even starts calculating what you owe. Compare that to where you probably are right now. A working married couple has a standard deduction around $29,000. The gap between those two numbers is not small. That is thousands of dollars every year in taxes you simply will not owe anymore. Not because you did anything clever, but because the tax code was written differently for people in that stage of life. I used to think I needed to save $3 million to retire comfortably. I ran all the projections assuming my tax burden would look roughly like it does today. That math was completely wrong because I was applying a working person's tax lens to a retired person's financial life. Those two situations are structurally different. Retirement income from Social Security, from investment withdrawals, from pensions does not carry FICA. It benefits from larger deductions. And if you structure it carefully, it can flow through the system at a fraction of the tax rate your current paycheck does. That means you probably do not need to replace 100% of your working gross income to maintain your current lifestyle. Most people need closer to 75% because a significant chunk of what you earn today goes straight to taxes and work-related expenses that simply disappear when you stop working. That changes your retirement number, sometimes by a lot. And here is something worth saying directly. If you have been quietly worrying that you are behind on saving, you are not necessarily behind. You may just be using the wrong calculator. The financial industry does not have a strong incentive to point this out. The more anxious you are about your balance, the more you contribute, and the more they collect in fees. That is not a conspiracy. That is just how the incentives line up. So that is the first layer. The tax drag from employment income starts to fall away when you retire, between FICA evaporating and deductions expanding. But that is just the foundation. The real structural advantage comes from something else, a place where your tax rate does not just drop, it hits zero. Consider someone I will call Jane. She is 67. She and her husband have been retired for 2 years. This past spring, they decided to take a trip to Europe, something they had been putting off for 20 years. The rough budget was $20,000. Jane called her accountant before booking anything. She wanted to know how much to set aside for taxes before pulling money from their brokerage account, the one with the ETFs they had been holding since their mid-40s. The accountant paused for a second, then said, "Nothing. You do not owe anything on that withdrawal." Jane thought she had misheard. She had not. Under current IRS rules, if your taxable income as a married couple falls below roughly $94,000, your long-term capital gains rate is exactly 0%, not reduced, zero. Stocks, ETFs, index funds, any asset held longer than 1 year can be sold at a gain, and the federal government takes nothing. Think about what that means in practice. Jane and her husband have Social Security coming in, mostly covered by the standard deduction. They have a small traditional IRA they are drawing from carefully. And then they have a taxable brokerage account full of appreciated assets that they can tap at zero federal tax, as long as they stay inside that income threshold. That is not a loophole. The tax code was designed this way for people who planned ahead. The common assumption is that the IRS notices every dollar. But with the right income mix, that is not quite how it works. A lot of your actual purchasing power can flow through at zero. Your effective tax rate on that $100,000 of retirement income can land in the low single digits, sometimes lower, not because you did anything aggressive, but because you built the right buckets before you got there. That is the 0% zone, and it is real. Now, here is where it gets uncomfortable. A lot of people watch this kind of analysis and walk away thinking the move is simple. Just max out your 401k, let it compound, and figure out the rest later. After all, you get the tax break now, the money grows tax deferred, and eventually you will be in a lower bracket anyway. That logic sounds reasonable. I thought so too for years, but that is also how people end up with no flexibility later. There is a version of retirement where you have done everything right by conventional advice, saved consistently, hit your number, followed the standard playbook, and you still end up paying taxes at a rate that surprises you. Not because you were careless, but because all your money is sitting in one type of account. And when all your money is in one bucket, you do not have choices. You just have withdrawals. Let me introduce you to Sarah. Sarah is 60, divorced, lives alone. She has $1.5 million saved for retirement. That is a real number. Most people her age would look at that balance and feel relieved. But here is the problem. Every single dollar of it is sitting in a traditional 401k. When Sarah needs money for a new roof, a car, a medical bill, she has no choice but to pull from that account. And every dollar she pulls gets treated by the IRS as ordinary income. Same category as a W-2 paycheck, same tax brackets. It does not matter that she spent 30 years building that balance. The moment she touches it, the meter starts running. Last year, she needed $85,000. Between the withdrawal and her Social Security, she crossed a threshold she did not know existed. Her federal tax bill was higher than she expected. That part she could absorb. What she was not prepared for was the letter from Medicare. Her premium had nearly doubled. I have sat with situations like Sarah's more than once. A few months ago, I was going over finances with a cousin who had recently lost her husband. She had not changed her spending, had not changed her investments, but her filing status flipped from married filing jointly to single. And suddenly, her entire tax picture looked different. She was not doing anything wrong. The system just treats those two situations very differently, and nobody had warned her that the transition itself would cost her. That is the single filer penalty, and it does not get talked about enough when you are married and filing jointly. Your standard deduction is roughly double what a single filer gets. Your tax brackets are wider. The income thresholds for capital gains, for IRMAA, for Social Security taxation, all of them are more forgiving. The 0% capital gains threshold for a married couple sits around $94,000. For a single filer, it is roughly half that, around $47,000. Same income. Single filer pays capital gains tax. Married couple pays nothing. That gap is baked into the code. It does not adjust for your circumstances. Widowed, divorced, never married. The math does not care. And then there is IRMAA, which stands for Income-Related Monthly Adjustment Amount. But really, it is just a Medicare surcharge that kicks in when your modified adjusted gross income crosses certain thresholds. In 2024, a single filer crossing $130,000 in MAGI could see their Medicare Part B premium jump from around $175 a month to over $244. Cross the next threshold, it goes higher. And IRMAA is calculated based on your tax return from 2 years prior. So by the time you see it coming, it is already locked in. What does that actually cost someone like Sarah? Let us put a number on it. You could do everything right on your federal income tax return, owe zero federal tax, and still get hit with thousands of dollars in Medicare surcharges because MAGI and taxable income are not the same number. A large 401k withdrawal, even one you needed, can push your MAGI across the line without pushing your actual tax liability in the same direction. Sarah did what most financial guidance told her to do. The 401k was the default. She used it. That is not negligence. That is what the system made easy. But because every withdrawal is ordinary income, every dollar she touches has the potential to ripple outward into her tax bracket, into her Social Security taxation rate, into her Medicare premiums. It is not just one tax problem. It is three things triggering at the same time. And most people do not see it until it is already happening. The trade-off of loading everything into a traditional 401k is not visible while you are working. The contribution feels efficient. Lower taxable income today, more take-home pay, employer match on top. The cost shows up later when you have no flexibility, when the only move available is a taxable withdrawal. When you are 65 and the government tells you exactly how much you must take out each year, whether you need it or not. That is the RMD, the required minimum distribution. Starting at age 73, the IRS sets a floor on how much you have to pull from pre-tax accounts annually. You do not get to decide. They do. And every dollar of it is ordinary income. If everything is in one bucket, you do not get to choose how much to pull. The government already decided. What you have is not a strategy. It is a withdrawal schedule. But here is what I want you to hold on to. If you are 45 or 50 and you are listening to this right now, you still have time. The window is open. You are not locked in. Picture two versions of yourself at 65. Same starting point, same income during your working years, same rough savings rate. The only difference is a set of decisions made somewhere between age 45 and 55 about which accounts to put money into. Version 1 sits down in December to figure out that year's finances. There is a spreadsheet open, a calculator nearby. The anxiety is familiar. How much do I have to pull from the 401k this year? How much will that cost me in taxes? Will this push me into the next bracket? Will it trigger a higher Medicare premium? The math works out? Barely. But there is no flexibility in it. Every dollar coming out is a dollar the government already has a claim on. Version 2 pours a coffee, opens the same kind of spreadsheet, and makes a different kind of decision. Taxes are a little higher this year, so the draw comes from the Roth account. Tax-free, no impact on IRMAA. Next year, if the tax environment shifts, the plan shifts with it. The brokerage account is there if needed, sitting on long-term gains that qualify for 0%. Same net worth on paper. Completely different experience of retirement. The difference is not how much they saved. It is how many choices they still have. That is what tax diversification actually means. Not spreading money across asset classes, but spreading it across tax treatments. Building a retirement where you are not at the mercy of whatever bracket you happen to land in, or whatever Congress decides to do next. The fragile version of retirement is one where all your income is pre-tax and mandatory, where the government sets the withdrawal floor and you spend your fixed income years optimizing around a schedule you did not write. The resilient version is one where you have optionality, where a bad tax year does not automatically mean a bad financial year, a bad year in the market, an unexpected medical bill at 68, whatever it is, you can absorb it without being forced into a taxable withdrawal at the worst possible moment. At age 73, the IRS requires you to start withdrawing from traditional pre-tax accounts, 401ks, traditional IRAs, whether you need the money or not. The amount is calculated by a formula based on your account balance and life expectancy. You do not get to negotiate it, and every dollar of it lands as ordinary income on your return, potentially triggering the cascading effects we just walked through. Higher brackets, higher Medicare surcharges, higher taxation on Social Security. One group spends those years managing the damage. The other group has options. The cost of not diversifying your tax exposure today is not a number you will see on a statement. It is the slow realization that you need $10,000 for a medical bill, but every dollar you pull has tax attached. It is the absence of options you will notice at 65, 70, 75. You followed the path of least resistance the system was designed to offer. That is not a character flaw. It is a structural outcome, but you can change the structure. And the time to do it is while you still have working income, Roth contribution eligibility, and enough runway to let the buckets build. You cannot control what happens in Washington, but you can decide tonight which account gets your next dollar. Tonight, open your retirement app, the one from your employer. You will probably see one button front and center. Contribute to traditional 401k. Maybe a percentage field, maybe an auto-escalation toggle. The whole interface is designed to funnel you in one direction, because that direction is simple to administer and easy to explain at an HR onboarding session. It is not necessarily the direction that serves you best at 70. So here is the blueprint. 3 buckets, each one taxed differently, each one serving a different purpose in retirement. The goal is not a perfect ratio. It is having enough in each bucket that you actually have a choice year by year based on what the tax environment looks like. The rough target to work toward is something close to one-third, 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 equal weight across all three. You will not hit it perfectly. That is fine. The direction matters more than the ratio. Bucket 1, pre-tax. Traditional 401k, traditional IRA. Keep contributing here, but only up to your employer match. If your company matches 4%, contribute 4%, and stop. The match is a 100% immediate return. Nothing else in personal finance competes with it. Beyond the match, though, you are just building a larger pile of future ordinary income. You are deepening the problem we have been describing. Do not overfund this bucket. Bucket 2, tax-free, Roth IRA, Roth 401k. This is where your additional savings should flow. You will pay income tax on contributions now at your current rate. But the growth is tax-free. The withdrawals in retirement are tax-free. That part most people know. Here is the piece they do not. Roth accounts do not count toward your MAGI calculation the way traditional withdrawals do, which means they do not trigger IRMAA. They do not push your Social Security into higher taxation territory. They are essentially invisible to the formulas that cause the phantom tax problem. If your income is too high for direct Roth IRA contributions, look into whether your employer offers a Roth 401k option. Many do. Bucket 3, taxable brokerage. Open a standard investment account if you do not have one. Not a retirement account, just a regular brokerage. Put index funds in it. Hold them long-term. This is your most flexible bucket. No contribution limits, no RMD requirements, no mandatory withdrawal schedule at 73. And if your income in retirement stays below that $94,000 threshold for a married couple, the long-term gains you pull from here are taxed at 0%. This is the bucket that gives Jane her European vacation without a tax bill. Yes, redirecting money into buckets 2 and 3 means your taxable income is slightly higher right now. You lose the immediate deduction you would get from a larger traditional 401k contribution. That is a real short-term cost, but you are buying something with it. You are buying flexibility, the ability to manage your own tax exposure in retirement, instead of having it managed for you, the ability to absorb a policy change, a life change, a bad market year without being forced into a taxable withdrawal at the worst possible moment. That trade is worth making. At 45 or 50, there is still enough time for the buckets to build into something real. The system defaults you into one bucket. Building 3 takes a deliberate choice made once and then maintained. That is the whole blueprint. I do not have a crystal ball. I have no idea what the tax code looks like in 2035 or 2040. Congress could raise rates. They could lower them. They could restructure brackets entirely. Anyone who gives you certainty on that is guessing, including me. What I do know is this: the people who will be least affected by whatever changes come are the ones who built options before the rules changed, not the ones with the biggest balance. The ones with the most flexibility. That is the whole point of the 3-bucket approach, not to predict the future, but to make yourself harder to corner by it. You cannot vote on tax policy from your kitchen table, but you can decide tonight which account gets your next dollar. So here is what I would ask you to do. Pull up your retirement accounts, just the summary screen, nothing complicated. Look at the percentage sitting in pre-tax accounts versus everything else. If it is 90% or more in traditional 401k or traditional IRA, you now know what that means for your future options. That number is your starting point, not a verdict. Take a moment to think about it. And if this kind of analysis is useful to you, the mechanics behind the numbers, not just the numbers themselves, then consider subscribing. There is more of this coming. We will talk again tomorrow.